Hello,
You're live.
and it's noon, so we're going to have pizza. But first, I have something to tell you. You know, I still remember we were at the Lake Burton a few years ago, and Uncle Bud,
Talk louder.
louder, and Uncle Bud said, Ray, you've been working on a business succession plan for about 15 years. And you're not any further along now than you were 15 years ago. I said, well, you got any better idea? He said, no. Well, now we got a better idea. I was trying to pick 15 or 20 people to either give the company to or sell it to them. And I thought, well, the other 200 or so will say, well, why'd you leave me out? And they didn't have a good answer, so we didn't do anything. But now we have. And thanks to a lot of smart people, that would be, first of all, Barry Schimler and Denise and Cindy. Of course, Denise and Cindy discount Barry. They say he's old-timey. But he's the one that suggested that we do. Cindy, what are you smiling about? Do an ESOP plan. I said, Barry, we've talked about that a lot of times. And I've asked some of my friends, and some of them like it and some of them don't like it. One of them dislikes it so much, he said he aborted the plan. He never did tell me why. Anyway, talked to another friend lately. He liked it a lot. And he said, I work 30 hours a week now. And he said, everything's great. Nevertheless, we have sold the company. And guess who we sold it to? The employees. And Michael is here to explain all that to you because it's well above my head. But I can tell you one thing good about it. Venture Construction Company will never have to pay any more taxes to the Internal Revenue Service. Cindy, aren't you glad of that? Yeah. Amen. So that's a good thing. And that, of course, means that the company will grow much more rapidly than it has in the past as far as net worth goes, because we don't have to send any to the federal government. In other words, it's treated in the same manner that pension plans are. They're not taxable. So that's a good thing. And there's some other good things that are too complicated for me to explain to you. The management is the same as it's always been. I could fire everybody today if I wanted to. But you know what? I don't want to, because I'd have to do everybody's work. Right, Uncle Bud? Yes. I still know how, but I don't want to. So I'm not going to fire anybody. Someday, somebody else will be in charge. Brooks is only 4. That's my grandson. So he probably won't work it out. But his mother told him the other day, said, Brooks, what do you want to do when you grow up? He said, nothing. And then he said, well, maybe I'll just be a shopper. He's been shopping with his mother and his grandmother a lot. And his mother said, well, Papa wants you to be a construction man. He said, okay, I'll be a construction man. Of course, he's just 4. By the time he's old enough to be a construction man, I'll be out and under, you know. So anyway, it's a great thing for everybody, and Michael here is going to explain it to you. If he's smart enough, I guess he is. And if he gets stuck, Denise will help him.
That's right.
Okay, I can't think of anything else to tell you about it, except it's a good thing for everybody. And everybody owns some of the company, whether you want it or not. What if they decide I don't want it?
We'll talk about that later.
We'll talk about it later. Thank you.
Okay, first, thanks for tuning in. This is our first live broadcast, and so we're excited about that. We're especially excited about the news that Mr. Morris just shared. Venture Construction Company is now owned by the employees. There's some very big and very successful companies that are owned by their employees, and it is It's just a great thing. We have the best group of people in any construction company anywhere. And I personally think it says an awful lot about Mr. Morris and Bud's confidence in the employees that we have and the team that we have, that they're willing to turn their creation over to us to continue into perpetuity. So I know you have a lot of questions. What I'm going to say is, if you have questions that come up during the presentation, send an email to Joey Hunt. It's joeyh@ventureconstruction.com. Send an email to her. She'll be accumulating those emails and then passing them on to us, and we'll have a question and answer session at the end. So but try to answer the majority of your questions. Our third-party administrator is Michael Miller. He is with Focus Pension. He's been doing this for a long time, and we're really excited to have him on board and have him as part of our team. So, Michael, take it away.
All right. Thanks, Denise. Good afternoon, everybody. So what I am here to talk about is this new ESOP. It really is very exciting. You are one of a select group of companies in the country. Now, some are smaller than you, some are bigger than you. Probably the biggest one around is Publix. They're an ESOP company. Some of these companies you probably have never heard of. Some of them you have. We could go down the list and you would know some of them. But what we want to talk about is, how does this affect you? You know, the company has been around, Venture has been around for a long, long time. And so the idea is that as all of us age and the company evolves, everybody's entitled to a retirement. And so one of the options, as you just heard, was, how is that going to happen? You know, there are different choices. You know, the company could shut down. It could be sold, like you heard, to just a select few of you. It could be sold to a third party, and then the name would change, the brand would change, everything would change. But one of the best options out there is what was selected, and that is to create an ESOP. An ESOP is an employee stock ownership plan, and what that means is that the company will maintain its name, it'll maintain its brand, it will maintain its structure. Nobody's losing their jobs. The management team doesn't change, the supervisory staff, all of the day-to-day things that you've done will continue, but you're going to add this new dynamic. When we talk about an ESOP, what we talk about is, of course, keeping the structure, because that's what got you here. You know, you have developed the way you do business in a certain manner, and it's worked. And you can look around and you can see that everybody is doing their job and doing it well. You know, in this first slide, that's just what we're talking about keeping our structure, about staying independent, about maintaining the culture. You know, when you come to work every day, you have expectations about who you're working for, who you're working with, how the company treats you, all of those sorts of things. And so why not share the wealth? And that's what the ESOP does create for you, is sharing the wealth of what the company brings to the table for everybody. But with that, there's also responsibility, because an ESOP, being an employee stock ownership plan, means that you're all going to be invested in company stock. So the idea is, what is stock? What is that, and how does that compare to profit? Because those are two different things. So what I like to talk about is in terms of a racehorse. So the idea is, if you've got a horse and you've got a group of people who own the horse, and then you've got another group that's interested in buying the horse, how do you come to terms with what are you going to do with it? So the thing is that first you're going to look at what are the conditions that we're working under, what are the facts and circumstances. So in this case with the horse, we're saying he's 3 years old, he has some good racing years left, he's been a racehorse, so he's earned some money and with his winnings, but there are costs for owning him. You know, and those costs include stable, food, transportation, insurance, training, all of those sorts of things. So let's say in this example, like I have up here, he's won $300,000, but he has cost $250,000 to maintain. So the question is, if you're the seller and you want to sell this horse, what do you want for him? And if you're the buyer, what are you willing to offer? So there's going to be a negotiation to figure out what is the real value. Okay, so some of the things is not only the financials, he's earning money and he's costing money, but what are the considerations for the future? What are the risks? What's the competition? What are the tracks like? If you're the buyer and you've got this money to buy a horse, what else could you do with this money? Could you go out and buy something else with it, make a different kind of investment? How risky is this investment? It's not just about your desire to own a racehorse, but if you're looking for a profit, then what are you facing? And what rate of return do you want? Do you think that the sellers did a good job and this spread, the 300,000 less the 250, is good? Or if that horse was under your ownership, can you make it better? Can you increase it because you have better competition or better training, or the food that you're feeding him causes him to perform better. So those are important factors. Well, companies are like that too, and so the price that you negotiate for buying or selling this horse is considered the profit. What's at the end of the day, and so what we're talking about is how many years left do we think this horse has? So if the answer is $50,000 a year that it's going to be profit, how many years? So we say, okay, well maybe it's 5 more years. So what's 5 years times $50,000? It's another $250 that you're gonna bring into the equation, and so that's a 5 times multiple. And the same thing happens with companies. There are risks, there are rewards. The company brings in revenues because of the jobs that are bid and won, and there's expenses because you all need stuff to do your job. You want to get paid for what you're doing. It's all of these things come into play, and so affecting the earnings. What is the net amount at the end of the day? What's left after you pay everything is going to be affected, and that effect is really what drives this share price. So if you say that $50,000 is what the share of stock is equivalent to, and you change the equation, well, the stock is going to go up and down just like that. And that's how stock and profit are related, and how that changes from what you do in like the racehorse setting to how companies are treated as well. Now, companies are generally, most of the U.S. is like this, are closely held businesses. Closely held is just a couple of owners in the company. It's most of the companies in the country, and it's more than half the workforce, the new jobs, and a lot of what drives the growth of the whole country. And so this is a special kind of category, and we're not talking about the Home Depots or the Coca-Colas or the General Motors that are public companies. These are privately owned. So when we turn into taking what a company can do and what it can do as far as preserving its future, say, well, what's this ESOP all about? Is this something that is just kind of a new kind of idea that's been just thrown out there, and is it going to stick around or not? The case is that ESOPs have been around since the 50s. They were actually put into the law in the 1970s, and although there have been plenty of pieces of pension legislation, you may have heard about things that they're affecting pensions in different types of industries, the car industry or what have you. A lot of times pension legislation is attached to some other bill that works its way through Congress. And so you might have a jobs bill or a transportation bill or something that seems completely unrelated, but they always attach these little pension things to it. What we find is that ESOPs have a special category within pension legislation. So even as other industries are cut or benefits seem to be going down or things like that, ESOPs are carved out of that. They have always had positive impacts in the legislation, and therefore the people that they affect. There has never been a piece of of pension legislation that has been negative to ESOPs. And this has gone on for a long time. And the reason for that is because Congress likes these. So they're not going away. They're getting stronger. There's other bills that are moving through Congress right now that are positive to pensions in general and ESOP specifically. But what we see is that the Democrats, they like to have, everybody wants to be an owner. It's a broad-based kind of a environment. The Republicans who are looking at taxes, they're looking at, well, your voters, and every congressman wants to be elected and reelected. So they want voters and they want owners, because owners make decisions. They think differently, they act differently, and when they come into an ESOP company, it feels different, because they know that every time you're walking into one of these types of companies, that there's this extra piece that you don't see in a competitive company, because you're focused on the bottom line. What can you do every day that's going to drive that stock price? And that's what owners think about. It's done in the small things and the big things. Where can we be more efficient? Where can we reduce waste? Where can we, deal with what's in the jobs that we're bidding? Everybody has a role, from somebody who is answering the telephone to cleaning the floors to building the job, because everybody's touching the customer in some way, from a revenue line or an expense line or both. There are not that many ESOPs in the country, and it's not for a particular reason, but we've got about 7,000 or to 10,000 at any given time. It does cover about 13.5 million employees, but that's not really a lot in terms of the country. What we've seen is an increase over time. They've been around for a long time, but as baby boomers are retiring, they don't want their legacy to go away. They've built very strong, successful companies, and you all are the reason why, because you do your job, you do it well, and you outperform everybody else, and that's why you keep winning these jobs. And so what has been built up over the last 30, 40 years doesn't need to disappear. But as people are retiring, what's going to be the future of the company? So the idea in this case is we're going to sell it to the employees. And so as a pure ESOP, there's not that many of them. But if you start adding in all of the other types of benefits in companies that offer stock or things like that, options and things that you've probably heard of in the news, you start to recognize that people want to be rewarded and have that be measurable. And measurable really does mean, what's the price of the stock doing? Now this is not a daily monitored stock, which means that you're not going to go and look it up on Wall Street and say, what's the price of my stock today? Because it's a closely held business, we're going to figure out what the price is once a year on December 31st. When there are groups out there that do statistics on these kinds of companies, and what they say is that you are in a really good company when you're in an ESOP company, and that's been proven out over many, many years. The companies that when they look at ESOP companies versus non-ESOP companies doing pretty much the same thing, the ESOP company tends to grow faster. They tend to provide more benefits, bigger balances, and they stay in business longer. So there's a lot of benefit to being in an ESOP company versus one of your competitors. So if you're bidding against another company or you're regularly competing against them, you can see that the effect of being part of an ESOP and looking at the stock price and understanding that part of what you get from here on out is company stock and you have some say in that, really makes a difference. Now, when I talk about having a say, I'm not talking about changing management structure. I'm talking about doing your job, doing it well, finding efficiencies, helping to grow the company, but for you and for all of the people that you work with. Because now if you're partners in this company, you don't want anybody slowing down the boat. You want everybody to be on the same page that you are in growing the company and doing your job the best that you can. You may hire people or look at people differently as you're growing, and you say, will this person be a good partner? Not just somebody who's going to do their job from 9 to 5, go home and come back. It's a little bit bigger than that now, because you really do have a stake in this. And this is what we're getting to. So remember, an ESOP is a retirement plan. When the company was sold to you, you are not writing a check for it. It does not get included in your tax return. This is built into a retirement type of benefit, just like your 401k plan is a retirement benefit that the account balances grow in there, but you're not really recognizing it in your daily life. So what we want to talk about is a couple things. I'm going to tell you how this plan works. It started January 1st of 2015, so we are already a year into it. It runs on the calendar year. The reason why we haven't really told you anything is because there's time frames that are involved. This is a very complex process. What happens is there's a lot of parties that are involved. It's independent. So when we talk about stock, we bring a company, a separate company in to say, what is this company worth? Well, that doesn't happen on the first couple days of the year. It's not like looking it up. Like I said, you can't go to Wall Street or the Wall Street Journal and look up a stock price. What happens is that there are attorneys involved. There's the company that values the stock. There's the accountants. There's all the internal processes. So what will happen is that every year, because this plan runs on a calendar year, the company will close its books, just like they always do. The internal financials will be developed. They'll give it to the outside accountant. The outside accountant will do what they need to do to kind of draft a tax return. Now, you're in a special situation because of the ESOP, is that you still have to file tax returns, but you don't pay taxes anymore because ESOPs have special tax benefits that go with them. So instead of paying Uncle Sam, that money can stay here. It can get reinvested. It can help grow the company. It can help, provide more opportunity. But the accountant does their job, and then it goes to the valuation firm, and that's a company that specializes in figuring out what are private companies worth. Then they do their thing, and they come back, and there's an independent trustee, and the trustee is somebody who kind of oversees the ESOP itself. That's independent from the company. So the firm that figures out what the stock is worth reports to the independent trustee, and they're the ones who settle in on what the stock price is. This is overseen by the IRS. It's overseen by the Department of Labor. And so with all of these independent folks that are involved, it means that the company cannot play games here. It's very serious and highly regulated, which means that when we tell you what you have in your account and what the stock price is worth, it means that the company did not influence that decision. Okay, so that's very important to know because, again, when we go back to the racehorse, the idea is, what's the stock worth? It's what's the negotiation between somebody who's willing to sell and somebody who's willing to buy, and we turn that into the stock price. But the company doesn't set that price; it's independent, and so the bottom line is it takes a long time before that happens, and it's months and months after December 31st before you see what you got in your account balance. So the idea is that this happened effectively on January 1st, 2015. So you may have already been in the plan, and this year we will start to put all of this together and give you a certificate once a year that says what is your account balance and what's it worth. In order to get into the plan, you need to be an employee. We're not talking about union people. We're not talking about anybody outside of the company. It's a closed group of employees. You also have to be at least 21 and have completed a year of service. So a year of service means you had 1,000 hours in 12 months. Now, A full-time person works 2,080 hours, but we're not giving you 2 years for that one calendar year. It's just 1,000 hours or more in the one calendar year gives you that year. So you did come into the plan on January 1st, 2015, if you had already met that. If you were hired after that date, then you're going to come in on the January 1 or the July 1 following the date you met that 1,000 hours and the year of service. So the other thing is that this is not like a 401k plan where you sign up. You are automatically put in. You are not, there's no opt-in or opt-out. You're just part of the plan. You're part of the employee owner group at that point. The things that you should get, which are going to be made available to you, will be a summary of the entire plan because we're legally required to give that to you. And also, we want you to complete a beneficiary designation form for the ESOP itself. That means that if you're married, it has to be your spouse. If you want somebody other than your spouse, then you have to have notarized consent of somebody different. If you're not married, it can be anybody you want. But it's important to complete that form and return it because you're in the plan anyway, so you're going to have an account balance, and just set it up and make sure you keep up with that if circumstances change. So once you're in the plan, the question is, how do you get an account balance? Well, in order to get a contribution, we're going to look at the employee group every year, and we're going to say, in this year, who had at least 1,000 hours of service, who was employed on December 31st also. So you have to have both of those conditions. Now, that does not mean that you have to be on a site on New Year's Eve. It just means you cannot be terminated from the company before the last day of the year. And so you don't have to be sitting at your desk or doing any building on that day unless you're scheduled to do it anyway. But we're going to look at those conditions, and if you met those conditions, you'll be eligible for a contribution. So there are different ways you can get money added to your account, and so you've got contributions. Because it's stock, there could be dividends, and I'm not saying any of these things are going to happen in any particular year, and all of them could happen in any year. And then forfeiture, so we'll talk about that in a minute. But between those three things, those are the way you're going to get contributions or additions to your account, and the additions are going to be in company stock. So it's not going to be cash, and it's not going to be your choice of investment. This is a separate plan from your 401k, which you've got lots and lots of choices for diversification in funds or stocks or bonds or whatever's over there. But this is only going to be company stock, and it's kept separate from the 401k. So your contribution is going to be based on how much did you earn. The plan is set up so that the stock is going to be granted to employees every year for a lot of years to come. And so the idea is that there's going to be a contribution that's going to be made from this general account into your account, and it's going to be some percentage of pay. And that that percentage can vary every year. So it's not like if you got 10% this year that you should expect that every year. It could be 5% next year. It could be 12% next year. Don't know right now. There is a range that is required, and there's a range that is from a minimum that's required to a maximum that's permitted. So the company has some discretion within the range, but I can't tell you what that's going to be. So every year we're going to look at this, and you're going to get new stock added to your accounts. Then the idea is, well, how much do you get to keep? Because you've got an account balance. Then we talk about vesting. Vesting is really how much are you keeping when you retire or you leave. The idea is that, again, we're going to look at 1,000-hour measurement in a year. 1,000 hours or more is going to grant you a year of service. And so, although this slide here says vesting begins at when the plan started, we actually went back and fixed that to say that all of your service with the company counts. So a lot of you, if you've been here for 6 or more years, you're already 100% vested. That means everything that you get in that account is yours to keep when you leave. So, and I'll talk about that in a minute. But otherwise, it takes 6 years to get 100% vested. Year 1, you're 0%. Year 2, you're 20%. And then 40, 60, 80, 100. So that's what vesting is. And if you leave before you are 100% vested, then you're going to forfeit your non-vested amount. So if you're 40% vested and you leave, then 60% goes back to the pot, which means that that's an additional contribution that everybody else who was eligible and is here will get. Because remember, this is a closed group, and the stock stays with everybody who is an employee. When you leave, there are distribution rules, but the idea is that you're going to keep your vested amount and it's not going to be taken away. What can happen, though, is that the stock price will change because you're invested in company stock, and just like any investment, it will go up and down. And so your price does not ever lock. And I'll talk about that in a couple minutes. The time for getting paid out is because of retirement, death, disability, or termination of employment. And they all have special characteristics. So if we look at your vested account, when you leave, if it's worth less than $1,000, the company is just going to pay you out. And because it's considered a small enough amount that it's not a hardship for the company. Because remember, now that you're in an ESOP, this is company stock. So remember when I started off saying that the ESOP is invested in stock, and we're looking at what's the price. So what's the revenue versus the expense. So as part of the company and actively employed, you really want to preserve that cash flow, because if you're paying it out, you're adding expense. So, if everything else is equal, you could be dropping the price, right? So the idea is that $1,000 isn't really that much in terms of what the IRS says. So they're going to say pay everybody else out. When your value is over $1,000, the company has some rules that have been put into place, and part of this is what's just in the plan document, and the company didn't really have that much to say about it, so you can't blame them. But keep in mind that you're putting on a different hat, and I know you're going to say, well, it's my benefit, I want to get paid, I'm out of here for whatever reason, I need it. But when you're still working here, you're going to say, well, this was put in because we want the stock, we want the price to be preserved. So the idea was that is that there's going to be a waiting period. There is a 5-year wait once you leave employment before you can get paid out, and then you're going to be paid out in installments. And if you think about it, this company is worth a lot of money, and it doesn't really matter, if it's a big number or a little number, but you've got stock in your account and that's worth something. So when the company pays you out, it needs to spread that cash flow so that it doesn't harm the company. And remember, you're still invested in company stock until you're not, and the price will go up and down each year. So what happens is that there's this waiting period, and then you'll be paid out the installments. So if, say, you have 10 shares of stock, when you get paid out in that 6th year, because you got to wait 5 years, you're going to get paid out 2 shares at whatever the price is that year. And then in the next year, you're going to have 8 shares of stock, and you're going to get your next 2 shares, and the price will have changed. So you're going to get that. So remember, even after you leave the company, you're still invested in this company, and so you should be concerned about the future and the growth, which I've had some groups where the employees, if they leave, they want to go to a competitor. Well, that's not really that's okay, except for you don't really want to slam the company you used to work for, because you're only going to hurt yourself if the stock price goes down. So keep that in mind. Now, it is a retirement plan, and that comes with retirement plan rules for getting paid out. I'll go back for that. Thanks. And that means taxes. So when you get paid out, you have the choice of either taking a distribution in cash or a rollover to an IRA or another company retirement plan. If you take it in cash, there is a you're not, because you're not taking the stock with you, you're taking the value of the stock for your payment. So you're gonna, if you take it in cash and put it in your bank account, there's a 20% withholding off the top. This is government mandated. And if you're not 59 and a half, you have a 10% early distribution tax, and you have income tax. If you roll it to an IRA or to another company retirement plan, taxes are deferred. You get 100% of whatever the distribution amount is. So keep that in mind, and also keep your address and beneficiary forms up to date with the company while you have an account balance, because you want to know how to reach them and they want to know how to reach you while you still have a balance. So the thing I said was that there's a waiting period before you get paid out. Now that does not apply if you reach retirement age and you leave employment. And retirement is not to say, well, I started here when I was 20 and now I'm 50, so I've been here for 30 years and I'm ready to retire. That's not retirement in plan terms. Retirement in plan terms mean that you're at least 65 and you have 5 years of service. So that's what retirement means in the ESOP. And just because you reach retirement age, first, does not mean you get paid out, because you don't get paid out until you leave. And second, it doesn't mean you stop getting benefits, because as long as you're working, you're still going to participate in the plan. So just keep that in mind. Retirement age strictly really means vesting, because if you are not here for 6 years and you reach that retirement age, then you'll automatically become 100% vested. There's only one time really while you're employed that you have access to this money, and it's a 6-year window. It's called a diversification window, which the IRS says, well, you're getting close to retirement, so we want to be able to give you some access to it, to your account balance. And what that means is that if you're at least 55 and you have 10 years of participation in the plan, so this isn't going to happen anytime soon, but in the first 5 years, you can take up to 25% of your account balance, so you can get to a quarter of it. And in the 6th year, you can get up to 50% of your account balance and get out of the company's stock. And so there are choices. We're not really there yet, so it's just informational right now. And the choice is really getting out of the stock means it's going to get paid out somehow, just like if you're in a distribution. Cash that's paid to you, rollovers or transfers to the 401k. Those are really the 3 ways these things happen, and you'll be provided more information when you become eligible for that. So that really wraps this up about what happens with the plan. We want to just kind of bring this back and say that what you're doing today has provided for the success of this company, and this is another way to link these two together, because now you're seeing that it's more than just what you're getting in your pay or your continued employment. It's really all about how is this going to affect you long term with linking the retirement plan, the ESOP, and the stock to what you do and what you have to affect that price. And remember, affecting the price has a lot to do with what you do every day. Some of it you can't control. The construction industry goes down, everybody's stock price drops because of what's happening in the world. But that's only a piece of what goes into how a stock is valued. A lot of this has to do with your day-to-day operations, and it really is a cyclical type of an event, because what we look at is what do your actions do to drive company performance, and how does that performance drive the reward, and that reward comes back to what your actions are. So we look at that circle, and hopefully what we're going to see is that over time the company value and your account value are going to increase. So just to summarize, because it's company stock, you want to find ways to increase your productivity, to reduce costs, and to look out for what your colleagues are doing every day, because you really are partners, and this is one more way that's beyond what most other companies do when they're doing their day-to-day work. because everybody's now really in this together. So I'm not sure if there have been questions that have been coming in, but please send them in. If there aren't any now, then we will address them later and make sure everybody gets to that. And I appreciate your time and the chance to be working with you, because it's a special kind of place, and you'll see that as the it's been great to be here before, and it's just going to make it much more dynamic moving forward.
Okay, there are a couple of things that I want to just make sure that everybody is aware of. When we are making the change to the ESOP, the way that we structure the profit sharing plan and make a contribution to the profit sharing plan, that's going to change because we'll be making a contribution to the ESOP. So, historically what we've done is we, as employees, contribute to their 401k. They choose whether or not to participate in the 401k. That part is not changing. Everybody was enrolled in the profit sharing plan once you met the eligibility requirements. And what we're changing is that the contribution that we've always made to the profit sharing plan, that part is now going to be done as a company match to your 401k. We're still working out the details on the percentage. It will be an annual contribution that will go in at the end of the year. It will be a percentage of your salary. So what we're looking at, this is not set in stone right now, but what we're looking at is a 3 to 4% match of your salary. So if you contribute 6% of your salary, then to the 401k, then Venture would contribute whatever that match percentage is, that 3 to 4%. If you contribute 2%, then Venture's going to contribute 2%. So we would match up to that, and that's an annual contribution. So the profit sharing plan contribution is not going away. It's changing over to a match on the 401k side, and then it's also will now, like I say, be contributing to the ESOP. Nothing's happening to the money in the profit sharing plan, so don't worry about that. The other thing that is changing related to the profit sharing plan is currently, as you know, you direct the investments on your 401k money, and Venture directs the investments on the profit sharing money. Well, that's going to change. We are going to make it so that the employees can now direct all of the investments on their 401k and their profit sharing balances. We'll probably maybe expand the menu choices just a little bit. We still have to provide a menu. That's a requirement. But you'll be able to then direct those investments yourself. So that's another change that we're making with that, giving you a little bit more control over that part of your retirement. Mr. Morris alluded to this. I just want to, kind of bring up a few points. Nothing is changing as far as the management. We're all, Mr. Morris and Bud and everybody's still here and still sitting at the big table. And so none of that is changing. What's changing is that we all now have a stake in how well we do. When we are responsible and can contribute to what our own retirement is. That we own it. We're Venture. The other thing when we were looking at what to do as far as succession planning, one of our biggest challenges that I see is recruiting, bringing in young folks to fill the needs that we have, and I feel like that this will be a great recruiting tool. I think it will be something that will be attractive to some of the people coming out of school, or for some of the younger employees, when they would have the opportunity to have something grow like this stock can grow. So, okay, we do have a question. All right, question is, if I understood right, you retire at 65, there are no disbursements until age 70?
Not exactly. Retirement age like I said, is a vesting trigger. It does not stop you from getting more contributions if you continue to work, and all you do is you get to be 100% vested if you're not there already. If you retire, you're not under that termination waiting period. So what'll happen is that in the year that you retire, we'll do your final calculations, and then in the following year, so you won't have to wait more than a year, until that year closes, because everything happens on a calendar year basis. So we have to wait, give you your contribution, update the price, all of those sorts of things. And so at that point, your installment payments will start happening. So it'll be the year following the year of your retirement, no waiting period. Okay.
Okay, that's the only question so far that has been turned in. Here comes Mr. Morris. If anybody has any questions, remember, email those to Joey Hunt. It's joeyh@ventureconstruction.com. And then also just know that this broadcast will be recorded and on YouTube, and we'll send out information later on today about being able to watch this. I know there's some people that obviously can't watch it while it's streaming. Mr. Morris?
What about disability? If we've got someone that's been with us like 30 years and they have a really bad car wreck and they're either mentally or physically disabled so that they can't work, what happens to their stock in the immediate future? How does that work?
Okay, so disability is considered like a disability retirement. So if you qualify for disability, like under Social Security disability, then you also become 100% vested immediately if you're not already, and you have no waiting period, just like the retirement plan. So you'll start getting your installment payment in the year following the year of the event. So that's true for retirement, for death, and for disability. And it doesn't matter if you've been here for 30 years or 2 years. It's whatever your account balance is at that time, and that's how this works.
Well, how will the immediate needs be addressed? In other words, if you had the situation I just described, you'd have immediate needs of medical expense, you'd have immediate needs of personal expense, but you couldn't work anymore. How does that work?
Well, we've got to follow the rules of the plan. So the idea is use some of your other stuff first, your insurance, your 401k plan, those balances, and that the ESOP is its own separate kind of an animal, and it's got its own rules that go along with it. So we have to wait a little bit until we can finalize those numbers and start getting you paid.
I have a comment. I just kind of joked when I was asked to announce this. This is really a good thing for everybody, because actually we've always been a company where we help each other, we watch each other, we help the company to do its best. But now you have a financial reason to do that as well. And like Denise said, if we have a need to hire people, field our office, to tell them that we're an employee-owned company is, as Denise puts it, a biggie. Who could not like that? Because if they're here a year, they'll own part of the company, as opposed to just being a guy or gal that's brought in and treated like not really part of the group. So it's good for everybody, and it's the best thing that we could do for everybody. Thanks.
Okay, we have a couple more questions. One is, does the stock have value from year one or only after purchase is complete?
Okay, well, the ESOP owns the company right now. It's just not all in your accounts, and it's going to take many years, and that's where the contributions come in. So the company has already been sold to you. So that's one thing. And because it was, there's already value. You're going to see that when you start getting your participant statements in how many shares of stock are in your account and what each stock is worth. So you're going to have your number of shares. It's going to equate to some ending balance, and then you're going to see that vested balance, whether it's 100% or something different. So the idea is stick around long enough, everybody's going to be 100% vested. You're going to take everything, and it's already worth something, and your job is to grow that. So that's where it is. This wouldn't have been sold for no value, but the idea is that it's worth something. I can't tell you what it is right now because I just don't know, and you're going to see it in your account statement when we send that out.
Okay, we had, and this question I can answer. Somebody emailed in and said that I mentioned a 3 to 4% match on the 401k. When does this become active? This will be active for 2016. So, and it will count, your entire salary for 2016 will count. So the money that you have already earned or money that you have already contributed into the 401k, then that is eligible to be matched as well. As soon as we get the hard details, we had conversations yesterday with Fidelity. We're trying to get this finalized. And so, I look to have this information to you within, a week or so that if you want to make a change to what your current deferral amount into the 401k, then you can do that as soon as possible. It is important to remember that we would do a match on your total salary, but you would also have to do that match on the total salary. So if you don't do a match on a bonus, if you don't contribute, to your 401k on a bonus, then that means that, but the rest of the year that you had a 4% contribution rate, then you didn't really contribute 4% to your 401k because you didn't have it come out of your bonus. So we would match, like I said, up to the same amount, up to that 3 or 4%, whenever we get that hard number worked out. Okay, so 2016 earnings will count. Now, there will still be a contribution to the profit sharing plan for 2015, and that actually gets deposited during 2016. So, we haven't finalized that number, but that will be more consistent with what we've done in the past. It's just starting in 2016, it will go to a match. Okay? And next question, when will we receive the first statement?
That's going to be a while. You know what? Remember what I had said earlier. There's a lot of steps in this process, and so remember the corporate books have to close, and those happen a little bit after December 31st because they got to reconcile all the bank accounts and things like that. Goes to the accountant, goes to the firm that figures out what the company is worth. Then it comes to me, and I put it all together. So it could be. It could be 8 or 9 months following the end of the year, but retroactive. So, and it's a good question because remember that say that you left in July, but the statements for last year haven't come out. That does not mean you don't get what's coming to you because you were here for last year. So you're still entitled to whatever it is for the prior year, regardless of what your status is on the day those certificates are issued.
Okay, the next question is, who determines the amount of shares we have on day one?
Who determines it? Well, it was part of the whole arrangement with the lawyers and everybody who went into this. So and it doesn't, the number of shares doesn't really matter because remember what matters is that the share is worth something. So whether that is, one share and you get a fraction of that, or it's 100 million shares and you get, 10,000 of them. It doesn't really matter. What matters is how much are you getting in that year and what's it worth. And that's on a schedule. And so, like I said before, I can't tell you you're going to get 4% or 8% or 20% of your pay from year to year, but there is going to be something that will get you shares into your account between something that's required and the maximum that's allowed under the law. And so there's going to be some range, but you'll get something each year.
Okay. That's the last question that we've received so far. I'll give it just one more minute to make sure that nobody sends anything else in. Again, we're very excited about this. I think this is a great move. just couldn't be happier about the confidence that Bud and Mr. Morris and that they have in the team that we have in place. And so, I think it's going to be an exciting time at Venture. So I don't have no other questions. So Michael, thank you very much for enlightening us all and teaching us about an ESOP. This is it's complicated, but it is going to be so beneficial to Venture and to all of our employees.
It is, and you all are just getting started, so think about this. You'll be getting some information, and if you've got future questions, just funnel them back through to Denise.
Right.
And we'll get everything answered and make sure everybody knows the same thing. And it really is exciting because you are an employee-owned company, and that means something different now.
That's right. Did you want to close?
I'd like to say thank you, Denise, for making this happen. And you probably couldn't have done it without Cindy.
Absolutely not.
Now, I don't know if Barry helped you or not.
Not really.
I know that there's some lawyers and some people in New York City that helped you, but we paid them a lot of money.
We
So
did.
I first told Denise she couldn't make it happen because it was such a large endeavor. But you're to be congratulated.
Well, thank you.
All of you.
Thank you. All right. Thanks for tuning in.